Maybe we'll get started by talking about FP&A.
As founders, you're innovators, you're looking at problems that exist in the market. You're looking for new age solutions to help solve those problems. But then you finally get your seed round, you have money in the door. You have a fiduciary responsibility to your investors also to take care of that funding. And so how did you guys deal with that new responsibility, and how did you kind of transition from being not only an innovator but also an operator?
Yeah, I gotta confess, like many early stage founders, when I started out, I had no idea how to do any of this, right? Usually you come up with an idea, you get your co-founders together, you start building product, you're focused on your customers, you're focused on growing. You're really thinking about how to manage and plan for your finances, but there's some inflection point that'll come that'll make you want to think about it. So I think for us, one of the big ones was as we started, we raised our first round, our seed round. Back then, seed rounds weren't as big as they are now. I think it was about 750K. Once we started hiring people, that was the first inflection point at which you needed to start thinking about financing, because generally once you start hiring people, that ends up being your biggest expense. Starting out, I've heard from a lot of founders in a similar situation where they spend just tons of their time worrying about and dealing with their finances and thinking through their finances when they could be spending that time like building their product. And so how do you set yourself up for success early on with the right processes, the right tools, so you spend less time, once a month, like spending a day dealing with this, and then when tax season comes around, you might be spending like a week or two doing it, and then let's say you're raising Series A where there's more due diligence, or maybe you're going through an acquisition. It's a whole bunch more time that you're spending dealing with your finances. And so that was definitely something that stressed me out at the beginning, and I didn't really know how to do it, and I felt like I was kind of fumbling along. And then eventually found a CPA, but I felt like they didn't know what they were doing either, or weren't as experienced in it. And so, yeah, it never felt like I was kind of on top of it, and it definitely created a lot of stress for me as a founder. I'm curious, like, how you'll experience it both as a venture-backed startup with Pry, and then also what you hear from your customers too.
So actually, before Pry, my co-founder Andy and I worked together at his previous startup, where we managed our company's finances in Excel. And back then, there weren't a lot of options. When we set out to build Pry, we knew from day one that it's super important to keep your finances in order. We knew that many startups fail because they run out of money. And with this in mind, like, Pry fills a gap in the market where we become a accessible solution to founders, especially those who don't have a finance background. And essentially, we built Pry for founders like ourselves.
What are some of the kind of key metrics that you guys were tracking early on that Pry helps track as well?
The number one metric that we always look at every single day when we log into Pry is our startup runway. And for a lot of companies, there's also like the number of customers, revenue, burn rate, etc. Different industries would track different metrics, so it all varies.
So I'm mostly focused on product, and so I usually look at product metrics like monthly active users, transacting users, etc. But obviously on the finance side, there's important metrics that you might want to start tracking, especially as companies become more mature. Many SaaS companies have like metrics they track as well. I was curious, like you mentioned some abbreviations earlier. What are some of the key metrics that like Brex tracks today when it comes to our finances that like investors care about?
Yeah, so we're at a stage of our company where those things I mentioned before, like those are all related to revenue growth and customer acquisition. The way we think about that is we want to be honest about like what it really costs to serve our customers today, especially as we grow. So making sure that you understand your cost structure in serving each customer, being able to allocate those costs, whether it's from your customer experience team, whether it's from vendor partners that help, like for us, processing transactions, and assigning that to the revenue and having a really honest gross profit number, that's been really important recently.
And when you're going a bit earlier stage, Tiffany, what does it look? What are the kind of key metrics you find that your customers are focused on?
Yeah, so for us, we work with a lot of customers who are in the SaaS space. So one of the key metrics that a lot of SaaS companies measure is MRR. So that's the monthly recurring revenue. That's really important to see like how much money you are receiving every single month. And then there's also the other metrics too, like churn rate, and also your burn as well. That's also something to keep in mind. And yeah, for Pry ourselves, those are the common metrics that we track too. And if you can see some of the dashboards that we have, like we also show kind of like examples of variables and metrics that a lot of founders track.
And if I understand correctly, in Pry, you can kind of automate calculating those metrics to some degree.
Once you build a model, yes. So we still require the founders to build your own financial models because we do take into account your assumptions. Like, for example, how many customers you forecast to bring on every month, or what's their growth rate, what's such expected churn rate. So these are the assumptions we typically need in order to build a model. And then once that's built, it's pretty much automated. And then you can adjust the assumptions as your business change.
So you mentioned a model, Tiffany. Erik, can you talk through what kind of a financial model is so people understand that? Because I know that Brex, we have been operating from model probably from like day zero, right? But most people maybe don't do that.
I think the one thing that we made sure we also, this is a tenet within the finance organization at our company, but we wanted to ensure that investors saw that we were taking real responsibility for any cash that they gave us. So we really highlighted how we were projecting out our cash flows, like at the bottom line, and what our burn looks like. And then we tried to tie in that burn that we were incurring to revenue growth that we expected to see from growth in our existing product line, which was on the corporate card, but also other product lines that we ended up launching later on, like Brex Cash and et cetera. So it was important to show that we're taking this money and that we're not just going to be spending it I don't want to say frivolously, but we really cared a lot about giving a return on that investment. That relationship with the investor can be shown through the model, and I think that's something that's really important.
What do you do if you can't have a CFO as your first hire, which is most startups, I imagine?
Yeah, so I would agree. I believe that shouldn't be a problem anymore with affordable solutions like Pry. You can actually build a financial plan in less than 30 minutes on Pry. And one example, you can build a financial fundraising dashboard on Pry and share that with your investors to tell your growth plan in a convincing way. So for example, as you can see on the slide, there are some charts, some notes, some data on there that you can share with your investors. Another use case is you can use Pry to plan for different scenarios. For example, like if your engineers ship your features late and your launch is delayed and your revenue forecast is pushed back by 6 months, how would that impact your runway? Would you still have enough runway to keep going? So that's also very important to know as well and plan for. And then lastly, you can also use Pry to plan for your hiring needs. For example, if you know that one customer support rep can support 100 customers and you forecasted to have 500 customers by the end of the year, you will need to hire additional 4 customer support reps and also budget for them. So these are all very common scenarios where founders can use Pry for before they need to hire a CFO.
Yeah, I mean, I'll add in one thing, and I've seen kind of Pry's demo. The neat thing about it, I think a lot of seed stage, Series A companies, even Series B, they're still on QuickBooks. I know QuickBooks is the predominant ERP for a lot of companies at this stage. And what I noticed is like Pry just sits on top, takes all the data of your existing accounting, and it helps you look at your performance in a finance/strategic sort of way. You know, again, like I joined a company that was in a different stage, but even though we had finance people in the house already, having something like this on top of our QuickBooks instance at that time would have been really helpful. It just saves time. When you're really small, you have a team of, call it 20 people, you know, every minute counts, and to automate this type of work would have been really valuable.
One of the things I was curious about, what some of the common pitfalls are for founders that are kind of doing financial planning. I can give an example. My first startup, probably our biggest mistake was that we decided to get a bigger office because we were kind of bursting at the seams, and so we decided to get a bigger space. And I don't think we fully realized that total cost of what that would be and the impact on our burn rate. It probably shortened our burn rate by 2 or 3 months. And the total cost ended up being way higher than we predicted. And I don't think we really did the diligence of thinking through like, oh, how is this going to impact our burn rate and runway over time? What does this mean for our like total runway if we don't raise another round? And so I was curious, as I mentioned earlier, office is probably a less common as like a major capital expense now, but are there any other expenses that happen early or things you've seen through talking to customers that are common pitfalls?
Yeah, one common pitfall I would say is that when you're hiring, you should also include all the benefits and overhead costs that include with hiring someone. So for example, it's not just a salary that you're paying for employees, you also have to take into account the healthcare costs, the equipment costs, subscription softwares, anything that could supply the employee to do their job well. So that all comes in addition to the salary wages that you're paying them. And also payroll taxes as well. You also have to budget for the payroll taxes. So not a lot of founders think about all the overhead costs right at the top of mind. So we usually build that into our software where we have a section for like payroll tax percentage where the founders see right away. So they're like, oh, what is this? This is something that I have to budget for. So it just makes it easier and it's kind of like a template where they can follow to build out their model.
And just to give people a sense, like let's say the compensation for like a software engineer you wanted to hire was like 200K. How much more do you end up spending on all of that stuff? Is it like 10% more, 20% more, 30% more? I think it's a lot higher than people actually think, right? Tiffany, I'm curious, is like 30% more, 40% more? How much does it end up being?
Yeah, it varies, but I would say on average, maybe 20% more. A lot of founders budget additional like 20% just to keep things simple. And if you, basically for all of these expenses, if you build it kind of like a driver-based model, then it'll be easier to calculate as you hire each additional person.
Yeah, so if you're using a spreadsheet today and you're calculating your burn rate and you're thinking about hiring someone, at least add like another 20 to 30% to that like total comp calculation as you're thinking about your burn rate so that you end up kind of not underestimating. That's really important. I'm curious, like, in the case of an early stage startup, as we mentioned earlier, it's often the founder, CEO that's responsible for dealing with finances. Brex was pretty unique because we hired a CFO from like day one. But when do you find, Tiffany, do most of your customers start thinking about hiring someone professional to do this in the company?
Right. So with Pry, like if the founders are using Pry already, we actually have financial analysts that could assist for the early stage startups. And typically, I would say when a company is thinking about raising a Series B and beyond, that's when they usually need like a CFO or kind of professional full-time help on managing the finances then. Before then, founders can typically manage the finances themselves, either on spreadsheets or on a software like Pry. But the bottom line is just make sure that you have your accounting in place or bookkeeping in place. That's really important to get through all of the fundraising.
Awesome. So sounds like if you kind of have it set up early on with like a good model and spreadsheet or a tool like Pry, which saves you a lot of time building a lot of those spreadsheets out, you can go quite a long way before you need to hire a CFO. Now, if you're in fintech and you're working on things that require lending, maybe you'd hire someone a bit earlier, but that's like a useful thing to think through, is how can you set yourself up earlier as a founder so you can save time and then maybe delay that hire until you really need to do it.